Investor psychology affects individual investors and contributes to broader market behavior, such as market bubbles and crashes. It is important to understand investor psychology to increase your chances of financial success. Investors can reduce their risk by diversifying, using professional financial advisors, and improving their self-awareness. Successful investors focus on the long term and are patient. They avoid the temptation to tinker with their investments and allow them time to mature. Overconfidence bias. Overconfidence bias is a psychological phenomenon that leads investors to make bad investments. This can result in poor performance or even a complete loss of the entire investment portfolio. This phenomenon occurs because investors tend to overestimate their own ability to understand financial markets or specific investments. As a result, they may ignore data and expert advice and pursue risky investment decisions. Investors with overconfidence bias also have difficulty distinguishing between different types of information. In addition, they often believe that more information about an investment will lead to a better decision. This is not necessarily true, especially if the information is biased or irrelevant. Overconfidence bias can be particularly dangerous in younger investors who have less to lose from mistakes. It also appears to be more common among people who are new to investing, whose decisions are likely to be based on emotion and perceptions rather than facts. The research examined the determinants of overconfidence bias, including the illusion of control and self-attribution, in order to determine their influence on investment performance. Structural equation modeling was used to establish the direct and indirect effects of the three determinants. The model also included a control variable that measured the participants' risk propensity. The results of this study show that all three determinants of overconfidence bias have a significant effect on investment performance. Investor psychology plays a crucial role in the ebbs and flows of market behavior. Understanding this psychology is key to a successful investment strategy. It is important to recognize and overcome the emotional undercurrents of the market, such as fear, greed, pride, ego, or denial. These emotions can cause irrational decisions, which in turn can affect the broader markets. One way to avoid overconfidence bias is by analyzing past investment decisions and their outcomes. This can help you identify patterns in your decision-making, and you can learn from the good and the bad. Another strategy is to practice a pre-mortem, which involves thinking about the consequences of a decision before it is made. This technique can help you avoid making costly errors. Confirmation bias. Confirmation bias is a common mental trap that investors fall into. It causes people to search for information that confirms their pre-existing beliefs and ignore or dismiss information that contradicts those beliefs. It is a significant problem because it can lead to bad investment decisions. The good news is that confirmation bias can be overcome. The key is to be aware of it and consciously seek out unbiased evidence. This can help you avoid making costly mistakes and improve your performance as an investor. Confirmation bias can also cause you to cling to your prejudices and remain in your comfort zone, which can prevent you from discovering new opportunities. Many of the greatest investors will deliberately seek out diverse information and discuss their views with a wide range of people. Warren Buffett, for instance, invites a bear to his annual Berkshire Hathaway shareholders meeting so that they can provide him with a contrasting view of the market. Another common confirmation bias is the sunk cost trap, which causes people to irrationally continue a task they are not enjoying or that has already failed, such as a bad movie, a meal that is too salty, or an underperforming stock. This can be particularly damaging for investors, as it will cause them to hold on to losing investments in the hope that they will recover their losses. Other forms of confirmation bias include familiarity bias, self-attribution bias, and overconfidence bias. These are all psychological traps that can impact your ability to make good financial decisions. The best way to break free from them is to be aware of them and understand how they can influence your thought process. Being aware of these traps is important for any type of investor. However, it is especially important for those who are looking to be successful long-term. By recognizing these traps, you can avoid making the most common investment mistakes. Understanding the psychology of investing can help you achieve success, even in the most difficult markets. The most successful investors are willing to admit their mistakes and move on. Loss aversion. Loss aversion is a bias that influences our financial decision-making. People tend to place greater value on avoiding losses than achieving potential gains, a concept known as prospect theory. In their seminal 1979 paper, behavioral economists Daniel Kahneman and Amos Tversky described this phenomenon, and it is what gave rise to the term loss aversion. A study conducted by Stanford University professor Russell Poldrack measured brain activity as participants were shown potential monetary gains and losses. The results showed that people's brains responded much more to losses than they did to gains, demonstrating the powerful influence of loss aversion on our financial decisions. This research supports previous findings that show that individuals are risk-averse when they are thinking about their money. The study also found that individuals are more likely to be loss-averse when the amount they could lose is higher. This is because they feel a stronger sense of loss when a loss occurs, which makes them more cautious when making financial decisions. In addition, the study found that individuals are less loss-averse when they are in a position of power or wealth. This is because these individuals are in a better position to overcome a loss they might incur. It is important to understand the role of loss aversion in investing. Investors should try to avoid this bias by stressing potential gains and identifying worst-case scenarios to better evaluate their available options. They should also be careful not to let their emotions cloud their decisions. One of the most common reasons why investors make mistakes is because they fail to close out trades when they are losing. This is a psychological and emotional trap that many investors fall into, but it can be avoided by understanding how to recognize and combat negative emotions. Successful investors understand the importance of being able to recognize and combat negative emotions such as fear, greed, and regret. These emotions are often the reason why investors make bad decisions that end up costing them their hard-earned wealth. They do this by understanding the psychology behind investing and learning to be aware of their flaws. By doing so, they can make more informed and successful investments. Herd instinct. The herd instinct is the tendency to follow the crowd in financial markets. It is a human response to uncertainty that was useful in evolutionary contexts, but generates instability on a large scale. Moreover, it has been linked to social pressures, especially the fear of being excluded. Neurologists have found that the parts of the brain responsible for feeling pain cause exclusion from a group to trigger the same kind of reaction as physical pain. Hence, it is extremely painful to stand against the herd and be seen as a false prophet. Therefore, herding can be a dangerous force in the stock market. A successful investment strategy requires diversity of views and independent decision-making. When investors make unbiased assessments of securities and act independently, they create efficient prices that reflect the true value of the underlying assets. Investors tend to copy herd behavior when they see countless others jumping into the same investment. This is called market sentiment and can have significant implications for investment decisions. In some cases, herding can be positive, but it is important to examine the motivation behind this behavior. For example, in the case of GameStop in 2021, herding contributed to a large spike in share prices, but the underlying company was not growing and had no profit margins to support the price. In addition, the herd mentality can result in speculative bubbles that burst at the peak of hype. This can lead to investors pursuing the next new thing, overestimating the profitability of new technologies or overlooking traditional fundamentals. This is the cause of economic bubbles, which can result in steep investment losses. The irrational exuberance over dot-com stocks in the 1990s is one such example. In order to avoid herd instinct, it is crucial to be aware of the psychological biases that can impact your investing decisions. Having a solid understanding of these influences can help you make better investment choices and increase your chances of success as an investor. Ultimately, it is vital to remember that investing wisely is a long-term process and not something that should be done in a hurry.